Well, a common trading dilemma is having an unrealized gain in your stock position. Wait, how is that a dilemma? That's what we wanted in the first place. Especially after we saw that large run-up at the end of 2019. We probably are sitting on some positions with some good unrealized gains, which was what we want going forward. But we are faced with a conundrum. What do we do now? Do we close the position, take the profits, and risk missing out on further gains if the market trend continues? Do we sell half, take in some income and some profits now, and then hope that it continues to move up in price? Hey, maybe we're going to set a stop. Say, if the stock falls 5%, let's just get out with the wins that we have minus that 5%. But remember, stop is just assumed insurance. If there's an unexpected event, you don't get out at 5%. Now, we could reward ourselves. The stock has moved up. We could sell a call option, generate some premium, and lower the cost basis. But now we might have a capped upside and might miss out on further profits if the trend continues. Yes, many of us might be so lucky to be in this situation. But if we are in this situation, we are posed with a dilemma. Do we hold? Do we sell? Do we sell part of it? Do we use a stop? Well, let's take a look at some of these examples. In a paper trade from December 3rd, we could have bought shares of Shopify, SHOP, at $350.66. Shopify today is currently around $415 per share. Well, it's really around $413.33. We have almost $63 of gain in the position, about 18.1%. So, what do we do now going forward? Well, we could sell now. We could take that 18% profit, roughly $63 per share. This probably met my trading goals for any strategy. But was there a reason why there was an 18% move in a 1-month period? Good news, good earnings recently, strong sector, strong market, strong stock. Is there a possibility for more growth? And am I missing out by taking this 18% right now? Will my next position work out as well or be as strong as Shopify in the next few months? Which of course leads us to, maybe I don't want to sell all of it. Let's say we had bought 100 shares at $350.66. Now we can sell half of it at that $413.33 or so. The remaining effect, we now are left with 50 shares and lowered the cost basis down to $287.65 or so. We still have unlimited upside on the remaining shares, and we took $20,683 off of that initial $35,000 we put in to buy the 100 shares. Our break even is now down to $288, which is a significant drop from where we are at $413 right now. So that might not be a bad approach. But instead of that, why don't we keep the 100 shares, and I can just use a stop order or perhaps a trailing stop. Let's say we set a stop at 5% of the current price. This would be around $392, roughly $20.65 from the current price of $413. Now, if I got closed out at $392, I'm still at a profit of $41-42 from our original cost of $350. It's around 12-13% or so. But what are we heading into in the next couple of weeks? That's right, it's earnings season. That once in a quarter unknown, where we've seen stocks recently experience 25, 30, 35% declines for poor earnings or unexpected events. We've also seen stocks jump 25, 30, even 70% here with AXSM due to a very high valued earnings and surprise as well. So why is that important? Well, remember the stop is assumed insurance. If I put my stop at 5% and the earnings come out and my stock has a bad surprise and it drops down 25, 30, 35%, my order is triggered. But it's really just a market order saying close my stock whenever we're below this 5%. I can't get that 5%. I get whatever the market's offering, that 25, 30, 35% drop. In this case, the 25% drop from 413 would put us around 309.75. Now that's a loss of $41 from our purchase price. It'd be a loss of 12%. Forget about the 18% gain we have. We're now at a 12% loss. And even if I had closed half and lowered the cost basis down to $288, we'd still be at a profit around $22. That's about 7%. Still pretty good, but nowhere near the 18% we're at right now. So how about another approach? We did the right thing. We picked the right stock that moved in the direction we wanted. Let's sell an out-of-the-money call, generate some premium to lower our cost basis, and be rewarded for picking the good stock. So we could sell a February 4/15 call on our shares of Shopify for about $28 per contract. This would lower our cost basis to $32,266 or $322.66 per share. If the stock is above 415 at February expiration, we make over $9,000 of profit or 28.6%, 10% higher than what we have right now. So it looks pretty good. We lowered our cost basis, which lowered our break even. We can make 28% now instead of the unrealized 18% if the stock remains strong and continues up. But again, what are we heading into? Earnings season. Not only does the covered call not protect our gains fully from that 25, 30, or 35% or worse surprise due to poor earnings, but we also cap the upside. In case Shopify has strong earnings and runs up to 430, 440, or 450, we're capped out at 415. Again, yes, it's a strong return of 28.6%. And if I roll it, I'm only going to increase that by 2 or 3%. I'm not going to get back that 10, 15, 20, maybe 30 points that we missed just because the cost of the buyback of the call will be so high. So going into earnings, I probably don't want to cap the gains. And although the call helped me lower the break even, it doesn't protect beyond that new lowered break even if there's more of a decline than we're expecting. So what do we want when we look to lock in gains? We want a way to lock in our profits, but in a way that's better and different than the assumed insurance of a stop order. We want to generate income to reward ourselves, but at the same time, we want to leave the upside open. I want to keep that availability for further profits or a jump at earnings or more. And that is the hat trick for locking in gains. A guaranteed stop at the bottom, it's better than a stop order, bring in income, and leave the upside open. And we can perform all of this following the concepts of the radioactive trading techniques and the proper manual in the blueprint. With the proper structure, we can lock in most of the unrealized gains. Guaranteed, not like a stop order. We can get that insurance beyond this earnings coming up and even the next earnings 3 or 4 months beyond that if we choose. And we can generate income to reward ourselves and leave the upside open. Goal number 1, insure the stock position. There's a tool available on Power Options and the Fusion subscription at Radioactive Trading called the Insurance Tool. It's a very simple tool. We just put in our stock symbol, put in our cost basis, and then we run the results to see what we get. The tool will go out and find all of the available put options and all the expirations, show us the cost of the put, but most importantly, on the far right-hand side, that locked-in profit. Here I've highlighted the February 420 strike put, which comes with a cost of $24.20. However, my cost basis is $350.66, so my new cost would go up to $374.86, but I'm guaranteed to get $420 back, so I have a guaranteed profit of $45.14 or 12% on the position. It's not as high as the 28% we saw with the covered call, but this is a guaranteed return to the downside while the upside is left open. So this tool is great and I can toggle between the expirations, but let's stick with this February 420 strike example. I'm probably going to want to check the graph. It's great to see things numerically, but better to see it graphically. I'll use the menus there for more information on power options. Go to the profit and loss chart. And here we see a married put position that is what we call bulletproof. No risk, a guaranteed profit minimum of 12%, even if Shopify fell to $100 per share. We've purchased the right to force someone to buy our shares of stock at $420. We take our cost basis up to $374.86, but we have the right to get $42 back at any time, so we have a guaranteed profit of $4,500 or 12%, and we left the upside open. But goal number 2 is to generate income. I can do this right from the insurance tool as well. I can toggle between the put month expiration I'd want and also selling a call against it. And here we see some other examples of using different February puts combined with shorter term January expirations, where we still have a higher locked-in profit now of 14.5, almost 15%, with also still a guaranteed potential higher return if assigned on the short call position. But what happens when we sell the call, which we already saw? Yes, we lock in that guaranteed risk to the downside. We have a guaranteed profit, a negative at risk or bulletproof position, now up to 14.4%, because the extra $700, almost $800 we generated from selling the 425 call. We have a maximum profit in this case of about $7,260, 19.8%. It's interesting, isn't it? It's higher than the 18% we have right now. Not quite as high as the 28.6%, but remember that was a higher premium on the 415 call. Here we've purchased the put and sold a higher strike call for a lower premium. So we still have more room for growth. We have a guaranteed profit of 14.4% in the worst case scenario if the stock falls, but it does cap the upside. If Shopify jumps to 440, 450, 460, well, we get out at 425, and of course the put has lost most of its value with that large move. We don't take further advantage of the stock. So goal number 3 is to reward ourselves and generate income, but leave the upside open. Well, how about a riskless spread trade, such as income method number 6? That's one of the 12 income methods discussed in the blueprint. Here I could do a bear call spread, sell that January 425 for $775, and buy a higher strike 440 call for $395. Now wait a minute. I want to leave the upside open, and I didn't want to take on more risk. This is a bear call credit spread. This is going to lose money if the stock goes up, and I'm going to have to add in a requirement of $1,500 to cover the 15-point difference in the strike prices. Oh, sure, I generate $380, but this isn't going to work for anything. Well, in the proper structure, when we take our bulletproof or even a standard new married put position and we add a bear call spread, we're not actually in a bearish position. We're in a position where we have a guaranteed profit to the downside in this scenario. We generated income with the bear call spread, but the upside is left open. And why is that? Because your broker doesn't see this as a bear call spread. In the proper structure, this is essentially a covered call on Shopify with a protective put in place to bulletproof the trade and an extra long call at the 440 strike that you are paid to own. So if the stock goes up to 460, you still might get assigned at 425 on the Shopify shares, but now you've got a 440 call that's worth at least $20 that you paid $395 for it, but essentially received at a credit of $380 because of the premium you took in at the 425 call. It leaves the upside open, generates income to increase the bulletproof status from 12% up to 13.2%, and we have infinite upside profit potential going forward. That is the hat trick for locking in gains through earnings. Ensure the downside better than a stop order, generate income to reward yourself, and leave your upside open. Of course, the simple tools to help, you've got the insurance tool there on Power Options and on the Fusion subscription to find the puts that give you the best locked-in profit from your unrealized gain, which is guaranteed worst-case scenario. That locked-in profit is the guaranteed worst-case scenario, even if the stock fell to $1 per share. But then the perfect guide to generate income is in the blueprint at radioactivetrading.com. The proper structure, the best ways to lock in gains or start a limited risk position from the start. 12 different income methods, including other riskless spread trades, that income method number 6 I just shared with you. Case studies on the various income methods, what to do in a bullish market, a stagnant market, or a bearish market, with the limited risk already in place or perhaps a bulletproof status, but ways to still generate income and increase profits even though I'm in a protected bullish position and the stock is falling in price or stagnating. That is the perfect guide to lock in gains, have 12 different income methods, and have complete controlled risk trading. And now, of course, is the perfect time to pick up the blueprint. We've extended the end of the year offer through January 7th at midnight or 11:59 p.m. Go to radioactivetrading.com/EOY, click on the products and click on that blueprint there, and you'll take advantage of our 8 special bonus offers that we are running for the end of the year promotion, and you can still access through the end of Tuesday, January 7th. But it is important to remember that this offer will end. So the best way to lock in gains, start controlling risk, generate income, be able to leave the upside open with different riskless spread trades and in different market conditions, and the ability to bulletproof trades. You have no risk to the downside, can leave the upside open, and complete the hat trick for locking in your unrealized gains. To see more, go to radioactivetrading.com/EOY, but act fast because this offer will end soon in the next couple of days.